Hi, this is James Shug with Westpac London's end of day report for Tuesday the 22nd of November. Today's session started off on a reasonably positive note. The ratings agencies had issued statements about the US budget position, with the super committee failing to deliver the 1.2 trillion worth of spending cuts or budget deficit reduction over the next 10 years that they'd been tasked with. The concern had been that the failure of the US political system to actually be able to deliver, fiscal policy decisions could itself be reason for more downgrades or further downgrades of the US by the agencies. That was essentially one of the reasons that S&P stripped the US of the AAA rating that they had previously bestowed upon the US back on August the 5th. However, for the time being at least, there's going to be no ratings action, and that saw markets recover a little bit from yesterday's steep losses. However, since then, the developments during the day have mostly engendered a negative reaction in markets. Funding costs, for example, in Europe, bank funding costs in Europe have continued to rise. Government funding costs have as well. Belgian bond yields pushing higher, for example. Belgium, one of the core economies in the euro, just like we've seen with France, is now being impacted by this sense that it's not just the southern or peripheral economies and governments in Europe that have got problems. It could be a more broad-based focus on the debt of all the governments in Europe. And that certainly seems to be the case in terms of what we've seen in bond market action in the last few days and weeks. We saw a Spanish short-term paper issue. Basically, the Spaniards had to pay pretty much double what they paid at the previous auction just a month or two ago. This is absolutely unsustainable, and the concern in the market now is that unless we see absolutely concrete, firm, shock and awe policy action out of from European policymakers, that there really is no possibility of any end game that doesn't involve huge disruption, huge wealth destruction, and frankly social, political and economic chaos. And I think there's a very strong probability that could be the scenario that will have to become our base case before too long, unfortunately. Anyway, so there's that. On the US side, we had economic data, a downward revision to the third quarter GDP numbers. It was 2.5% annualised. It was revised down to 2%, mainly because of a bigger drag from inventories. Nevertheless, the positive data flavour that we've seen out of the US certainly wasn't reflected in that GDP revision today. However, we did see the Richmond Fed factory survey, which was a little bit stronger in its November reading, and later on tonight we get the minutes to the Fed's November 1-2 FOMC meeting. That'll provide a bit of direction to markets in a couple of hours' time. Probably there'll be some more detailed discussion there about how the Fed might engage in further policy easing, perhaps involving the purchase of mortgage-backed securities. So those are the main stories today. Oh, I should mention too, in Europe we had the advance read on November consumer confidence for Euroland. It fell from minus 19.9 to minus 21. At minus 21, it's lower than it was in the second and third quarters of 2008, and of course the European economy was in recession in those quarters, so we're already getting consumers feeling worse than they felt in the early quarters of the most recent recession in Europe. Another signal that we're probably already in recession in Europe. That's about it on the events today. In terms of, let's start with commodities first. Commodity markets, we've got gold prices up 1.2% today at $1,699 an ounce. Copper's up 0.9%, and we've got oil up 0.6%, looking at $97.51 a barrel. The Aussie dollar is at 98.3 US cents. It's been up and down today, seesawing, but it hasn't really found any new direction. In terms of equity markets, just after 4 o'clock in London, so another hour or so of European trading to go, we've got the London market pretty much unchanged on the day. German market, though, it's down 1%, and the French market is down about 0.5%. Oh, one other thing too, we had a reiteration or the German government re-emphasised that they certainly aren't backing down on their stance, that there is no big bazooka sort of policy tool available that they would agree to that might change the outlook for Europe. Basically, they said the policies that we've put in place are the ones that are going to remain in place, and the market has to get used to that. Yet another example, I've got to say, of the way that European politicians really don't understand how markets work. There's a lot of mistrust on the part of governments in Europe of financial markets, and of course financial markets in Europe think that the governments are crap, are rubbish. Doesn't make for a happy marriage, of course, and we're seeing that amply demonstrated at the moment. Okay, that's about it. A couple of things to watch for in Australia. We've got construction work done figures for the third quarter, one of the clues that we use to finalise our GDP growth forecasts for Australia. And Guy Debelle, one of the Assistant Governors of the Reserve Bank, he's speaking at a function talking about Basel III, banking prudential sort of regulations. Okay, that's it for today. I'll be back tomorrow, but that'll be the last time for a few weeks because I'll be working in Sydney for the rest of November and the first half of December. Okay, but I'll speak to you tomorrow.